Okay. And we'll wait as people are trickling in.
All right, Vic, while we're waiting, what's your favorite movie?
My favorite movie, I think nostalgically is The Outsiders.
Ah,
I still,
Good one.
yeah, that one is still, but I saw something recently that I can't think of it though right now. You just put me on the spot. So I
sorry.
don't know.
And I didn't realize, David, since I'm running the slides this time, that I can't see the Q&A or the.
Okay, I'll
I thought
monitor
we both
Q&A.
could. Okay, I
Okay,
can't see the
and that's
chat or the
fine.
Q&A. It's not
I'll let
popping
you
up.
know if anything comes up. Okay,
Okay.
well, we've got a lot of participants in already, so I think I will get started with the introductory stuff.
All right.
So, welcome everyone to the last session of Maze Live. Thank you all. If, hopefully, most of you have attended our other classes, but before we get started into this last session, I'm just going to go over some housekeeping items. And sorry if this is the sixth time that you've heard it, but it's also the sixth time that I'm saying it. So, but welcome everyone. So just please note that this session is being recorded. For questions related to the session, please utilize the Q&A button at the bottom of your screen. You can feel free to ask questions throughout the session. And when Amy and David get to a good stopping point or during the polling questions, that's when we'll go over those questions. If you prefer to pose your question anonymously, there is an option to do so. For any technical concerns that you have, please use the chat button at the bottom, and we'll do our best to help address that. There is a PDF handout of the PowerPoint slides for this class. You should have received them by email. If not, there is a link in the chat button right now, and Whitney will continue to post if it gets too far up the chat. And if you still don't see it, then just message us in the chat and we'll get the handouts out to you. Polling questions. So for attendance and CPE purposes, there are polling questions that will be going out throughout the class. In order to get CPE credits, you do need to respond to those polling questions. You don't have to get the answer right in order to get credit, but you do have to respond. If you have any issues, whether you can't see the polling questions as we're talking about them, or you're unable to respond to them, then please put your name in the chat and we'll make sure to track your attendance. Lastly, there is a survey that will be posted in the chat at the end of the class. Please complete that survey as soon as possible. When you click on it, the link will come up. It's the same link for all classes in case you've attended multiple sessions. We will also be sending out a thank you email to all attendees in a couple of days that will include the link to the survey. CPE certificates will be emailed to you within 2 weeks after we receive your survey. And so I'm happy to introduce Amy Meyer and David Alvey, my partners here at Mays & Associates. I'm not going to go through their full bios. I did that in the last class, and I figure probably most of you were in there, and their bios are really long. But anyway, they're both awesome. Been partners with them forever. And so they are here to present GASB 101, Compensated Absences Simplified. Okay.
Yes, finger
All
quotes.
Yeah,
We should have put them on there.
we'll see how simplified this
Yeah.
is.
All right.
Um,
Well, good luck, guys. I'll
Thank
let you
you.
guys know if any questions pop up.
Thank you.
Perfect. Thanks, Vic. All right, so GASB 101. So this one is kind of the big one for this year, the ones that everyone's been talking about for the last couple of years about coming down the pipeline. So today we're going to go through the effective dates and transition, why GASB is making this change, the scope and applicability, the recognition, when we need to start recognizing these liabilities, how we measure these liabilities, what the changes in the footnotes are going to be, and from an audit standpoint, what we think are impacts and what as auditors we're going to be looking for you clients to provide us when doing this, and they give you some resources that you can look at for the upcoming GASB. All right. So effective dates and transition. So this GASB 101 is effective for June 30, 2025. If you're a 12/31 fiscal year and client, it was for 12/31, 2024. And it really is going to change the way we look at comp abs. And the change that we do, we have to make sure that we follow GASB 100, the accounting for changes and errors. We have to make sure that if there is a significant change in that liability that needs to affect beginning balances, that we follow that GASB 100 and report that change in accounting or implementation of a new GASB in accordance with that. Okay. So why did we change? And while you're thinking about why GASB is doing this, we're going to have a polling question just to make sure everyone's here. So how many of you are still using the guidance under GASB 16 for your current policy?
And who even knows? We should have put that. Yeah, the I'm not sure, I guess, covers if you have no idea what even GASB 16 is. Let's just summarize GASB 16 as the way you've always been doing it.
Way it's always been done.
Yes. I don't know when 16 came out.
Oh, I'll get to that.
GASB 10 came out in it was effective in 1993. I only know, I'm not good with dates, but I know that because that's when I started with the firm, and GASB 10 was brand new.
And now we're at 104. That's crazy.
104, yes.
With 105 coming, right? The subsequent events soon.
Yes, by the end of the year. Mm-hmm.
All right, let's see how we're doing on the questions.
All right, we have about 91%. Should I end it?
Perfect. Yep.
Sure, that's great.
Sharing results.
Perfect.
Kind of the answers we expected, right?
Yep, exactly.
Yeah.
All right, so
let me close that. Here. Oops. That's right. Okay.
All right, so why the change? So like Annie was mentioning, GASB 16 is one of the oldest GASBs that are currently still in effect. It actually came out in 1992, November of 1992. Oh. And just to get some context to that, the hit movie, since we're talking about favorite movies, was Aladdin by Disney.
Oh,
the
wow.
top song on the billboards was End of the Road by Boyz II Men. So long time ago. So
oh my gosh, now it's in my head.
You see that in the back of your head for the rest of the presentation. Perfect. So because of that, a lot of things were different from now compared to 1992. You know, unlimited leave, sabbatical leave, floating holiday, leave banks. There was no guidance in those for paid time off in their GASB 16. And so that's why this kind of came in the limelight of we need to change. We need to bring that up to date to today's standards. And also the footnote disclosure, I laugh at the power strip is, as auditors, when we do the footnote disclosure for comp abs, you know, beginning balance, additions, retirements, and ending balance, we always plug one of the ones in there. Find whatever the usage was and plug the other, or what the earned was and plug the other. So GASB now has allowed us to make that a net number. And if you have not, Amy will talk about the footnote disclosure a little later, but if you have your comp abs as a separate note, you know, it'd be really easy just to show a net. But if it's in your long-term debt footnote, you just need to put one number and put a little asterisk by it down below that this is a net amount. So you can still have it in your long-term debt footnote, but it needs to be indicated that movement, either plus or minus, is a net figure.
Perfect.
All right. So the scope and the applicability. So compensated absence. So what is it? It is a cash payment when leave time is used or time off, or other cash payments such as payment of unused sick leave at termination of employment, or a non-cash settlement into a post-employment benefit. We see that a lot in a defined benefit contribution plan, a pension plan, that you can turn that unused sick leave or vacation into time earned into your pension plan. And some examples of comp abs. I mean, this again is probably very similar to what even though GASB 16 is so old, we kind of already have adopted some of these into our policies and procedures. But vacation or sick time, PTO, pay time off, holiday leave, parental leave, certain types of sabbatical leave. Sabbatical leaves I don't really see so much at least our makeup of clients. That's probably more of a university type thing.
Yeah.
But and I think actually at CMFO, Alan from GASB did ask if anyone had it, and I don't think I remember anyone raising their hands at that. But anyway, so for to define it as a comp, it has to have all three of those elements: cash paid, or has to have all three of those. It's going to cash paid for lead time, payment at termination, and could be non-cash settlement into a defined pension. All right. So also under the recognition criteria, we don't have the vesting. There's no more vesting. And we'll kind of show how that is an example of that later on. But so just remember, there's no more vesting criteria at all. And so
Yeah, it doesn't matter anymore.
right, exactly. Because again, the new catchphrase of GASB, if you were on our last presentation about more likely or not for certain constraints and concentration. So the recognition criteria has to have all three of these attributes to be able to recognize this liability. Leave has to be attributed to services already rendered, so it has to be earned by the employee. The leave has to accumulate from one period to the other, so beginning balances, additions, retirements, ending, and it goes for many, many years. And it has to be more likely or not that the time used will be paid at settlement. More likely, and Alan said from GASB again, that more likely or not is 50% plus a feather. So it has to be more likely or not that this is going to be have to paid off. And in terms of the one nuance I just want to point out here in the leave accumulates, the balance carried forward from prior year to the current year, is a lot of times we see that leave that is holiday leave or vacation leave or that sort of thing, pay time off, those typically in certain MOUs follow a calendar year. And it gets interesting when you look at that, because you have to, again, assess that at, if you're a June 30, if you're a 12/31 client, you have calendar year, no problem, easy. But if it's a, use it or lose it, and you're on a calendar year on the MOU, but a June 30, you have to take that into account when you're trying to calculate these balances. But anyway, so those three criteria have to be met in order for it to be booked as a compensated absence. Okay, next slide.
All right.
Poll number 2. So which of these is not part of the recognition criteria under GASB 101?
In our continuing effort to distract people with things unrelated to GASB 101. So what's your favorite hobby, David? Your favorite hobby? Because I know you have a lot.
I
have
was
a
gonna
lot.
say current one because it
Yeah.
changes,
Yeah.
every 2
I'm-
years.
No, I've kind of focused on pinball.
Yeah.
That's kind of my collectors and fixing things, but
It
yeah,
covers
that's,
all of your, that kind of brings all of your hobbies together, doesn't it?
it
Fixing,
does, because
collecting,
3D
playing.
printing, yeah, modifying like the electronics on it. Yes, exactly. That does bring a lot into it, and it's fun to 3D print things for my pinball machines.
That has to be pretty awesome. Yeah, because I can imagine that. Yeah, it does cover them all. It gets you going, and you can fix things. So perfect.
Yeah, a little tinkering and making stuff. It's fun,
And then you get to play.
and then that's a benefit too.
Yes.
And it's always fun to see people, brand new to the hobby, like start playing it. Or I played at a local arcade called the Flipper Room here in Concord, and when you see somebody walk in for the first time and their eyes bug out, welcome to heaven.
Yes.
Hey, Miss Whitney, where
Hey,
we at?
welcome to heaven. I'm gonna end the poll.
Oh, you're trying to impress us. Awesome.
Very good. Very good. Perfect. All right. So continuing on with the recognition criteria, the evaluation. So, and really it's that third one, right? It's that more likely or not that the leave will be settled in a cash payment or settled through non-cash means. And really, this is something that as an auditor, we can't help too much with. And I say that because when you're recognizing that it's more likely or not that person will not burn through, or that person will burn through all their sick time rather than get it paid out at 50% at retirement. We don't know that. I mean, that's based on your historical trends. That's based on your employment policies. That's something that you as an accountant have to look. And the GASB is kind of a little bit not vague on this, but we've kind of been teetering around. Maybe look back at trends for the last 3 to 5 years. You don't have to go back to the inception of your city or anything like that, but just look. Okay, yeah, typically people burn through all of their sick time because that has a 50% limitation at payout, or they don't. So you have to look at your policies and procedures, whether your historical trends of use of those payments, and then if there's any other specific information that like a general manager will use it or something like that, that's more specific to your entity. So you got to take all this into account. And then I also when you're doing this, you have to take this into account using current rates. So we're not trying to project out rates, what somebody's going to be when they retire or terminated. So you use the current rates. And one thing that was interesting, I keep talking about the GASB presentation at CSMFO, but it's just always interesting to see. Like I said in my previous class, we've been through a change in the main contact person. I feel like there's a change in the mood that we're really looking more toward a materiality standpoint, and Amy's working on a project about that a little bit. We can talk about later, but if you got to look at the materiality of this change, and if it's material or not to book, you have to assess it regardless. That's a step one of every single GASB. You got to assess what the change is going to be, and then look to see, okay, is this going to be a material impact to the financials? And if not, maybe you don't book it or not. But all right, next slide. So exceptions, we all like exceptions to these GASBs because it gets us out of having to do anything. The first exception, that it's more likely or not that accumulated compensated absences at time of termination will be converted into defined benefit post-employment benefit program or post-employment benefits. So that can be pension or OPEB. And the reason that, so if it's more likely or not that the person will roll that into their pension or OPEB, technically that is already calculated by the actuary and is already in your net pension liability. So so you exclude those payments from the liability. The second one is the leave impacts a very small or group of people, or really can't be calculated regularly. And so the examples they give of that are your jury duty. You don't know when you get called. We had one of our managers have jury duty back to back in like a year. Parental leave and military leave. So those would be excluded unless they have occurred. So if you have a person that is going out on paternity leave and that covers that crests over a fiscal year end. But again, the materiality comes into play here, where if it's just a single person, it probably wouldn't change the liability. No sabbatical, so this is not having to do with sabbatical or sick leave. And then the third is unlimited leave or holiday leave when taken outside of a specific date. And again, those are kind of exceptions that those affect only a very small group of people. First of all, I don't think any of our clients have sabbatical leave, but the leave taken on a different date, the only thing I can think of is for like our 12/31 fiscal year and clients, if you have police or fire that take, the holidays at a certain different time, maybe after the new year, that sort of thing. But again, those are very specific to a specific group of people and really wouldn't affect overall materiality of the total liability, and that's why they're excluded here.
Agreed.
Right.
And we're gonna before we go on to the next slide, there is one question that kind of covers in all of this world here. So if use it or lose it is leave granted for a calendar year, and as of June 30th, the person has 50 hours balance, is the 50-hour balance included in the liability? That's a really good question, because that is what David alluded to it earlier in the class. Do you want to?
Yeah, so yeah, you definitely, again, looking at historical trends, yeah, I mean, it should be in the liability. And that's because historically, probably people will use it rather than lose it. So, but then that's, Amy and I were talking about this earlier. That's the hard thing about kind of having a broad, brush of this GASB. So it's completely different for each organization. You might not have fire, you might not have police, my districts versus my transit versus, community service districts. They're all different. They all have different kind of history, and they all have different kind of employment MOUs. So it's really, you have to customize it to your organization.
Agreed. Yes. All right, so now we're going to get into measurement, but of course we have a silly little joke here that's one of my favorite accountant cartoons. All right. So we've got the big, before we start getting into this discussion a little bit more, like David talked about, don't forget materiality. But as David mentioned, you do have to do the overall calculation, determine your liability, because if you think about it, if you think about like what was in your financial statements last year, your compensated absences, if they weren't material last year, most likely it's not going to be material under the new statement. So you may not have to do any of the restatement. You may just do the changes in the calculations prospectively, but you still have to go through the process just to make sure, because it could be that last year was a little bit not quite right, because again, maybe you're going to have to pull in some of the sick leave that may not have been recorded in the past and things like that. But you still have to go through the process to make sure. And when we say materiality, material is specific to your entity. There's no one way about it. It's specific, and it's different than auditor materiality. So don't get that in confusion either. Your materiality is going to be specific to you and your processes and procedures, but it's something to start thinking about. And when we talk about materiality, there's different ways to look at it too. There's the whole balance as a whole, and then the restatement, because maybe, and I think David said it, maybe the ending balance, it is material. You do need to implement the statement, but maybe the change in the beginning balance isn't material. So then maybe you just roll it through the current year. So, but you're not precluded. You can restate. So you're not excluded from doing that, but it's just a matter of keeping that in mind. And that's where you want to think about kind of the overall big picture when you're starting to gather your information, do this gather, multiply, add. When you're gathering all of this information together and pulling it into your calculations, you can analyze it down to, as my family says, down to the gnat's fanny. You can analyze it every way from Sunday, but you still want to think big picture, right? You can get down into the weeds, get there, or there are ways to do it more on a grander scale, kind of, you still have to do some assessments and looking at things. But if you find yourself getting too bogged down, maybe it's a time to step back, ask a few questions, ask for some help, run it by the auditors. Am I on the right path? Am I totally off in left field, or am I doing okay? You want to make sure you're not wasting time. You might still need to keep moving forward with what you're doing, but maybe you have gotten off track a little bit and you need to get pulled back into it. So don't make sure you're not working in a bubble. Ask your friends, as we say. So the process to begin with your measurement. So you gather, right? First, you have to gather all your information. They accumulate your leave that meets the recognition criteria. So David's gone over the recognition criteria, what gets put into the liability. Now you have to gather that all up. Get your leave balances, get your different information, get your historical trend information when you're trying to figure that more likely than not. How likely are people going to use the balance down to the dollar and not cash anything out at the end? Do our policies, did we miss something in the past? That's something to look at. Maybe that MOU has a little nuance in the MOU that you missed something and the liability's been slightly incorrect, we'll just call it, in the past, that you can pull that in and fix any of those things now moving forward. So then the easy part, multiply the leave hours by the year-end pay rate. And when we say leave hours, that's going to be the ones that are now subject to the measurement, right? Your ones that are going to be recognized under the liability, whether it be at a 50%, at some other criteria, some other component. And then it's the year-end pay rate. You're not using, as David said, not a future rate. It's the rate as of the end of your fiscal year, whether it be a 6/30, a 12/31, or some other date. And then or an other rate if in the MOU, that's where you get into those components. If it's being paid at a 50% and it's always going to be paid at 50%, then you are going to factor that in, but it doesn't mean, which you'll see on some of our examples, it doesn't mean that you're automatically taking 50%, because if you're going to use it, it's at 100%. So that's where those little nuances come in. And then you have to add salary related payments that are directly or incrementally related to those leave balances. So when and if they get used or paid, what other components should be part of the liability? And salary related payments. The easy one at a minimum, you're going to be adding the employer's share of Social Security and Medicare. That's the easiest one. So what is it? The 7.5%? Multiply everything by the 7.5% and add that in. That's the easy one if that's applicable for your agency. I'm going backward on the bullets below. You are not going to include any defined benefit pension or OPEB contribution. So if the cash out, at the end when the cash out happens and there have to be some defined, some pension payments related to it, you're not going to add those. Why? Because that's already factored in your pension and OPEB liabilities at the end of the fiscal year. So you would be doubling up if you then added pension and OPEB stuff to the compensated absences liability. Now, on the other hand, that's for defined benefits, so like your CalPERS and your most of your OPEB plans. But for your defined contribution pension or OPEB contributions, so defined contribution plans, your 457s, your 401As, things like that, or any other kind of defined contribution pension or OPEB plan, that's recognized. If it's recognized as the leave is earned, then it comes in as part of the liability. But if it's not, then it's not, if it's because the defined contributions, you think about it, you don't have a liability on the books at the end of the year for defined contribution plans. You have a disclosure saying how much you paid. So those may need to be rolled into the compensated absences liability. So going to be pretty few. And again, just the employer portion. We don't care about the employee's contribution to those particular plans. It's just what you as the employer is going to have to pay. And so, but at a minimum, you're going to be increasing it by that, the share of Social Security and Medicare taxes. And I know that's not, some of your entities, depending on the age of your entity, may or may not have pay into Social Security. So maybe that's not coming in, or maybe it's coming in for groups of employees. I've seen that on a spreadsheet from a client where they had to factor that in, that it's applicable for this group and not for this group. So you do have to think through that as you go forward. So some other notes about measurement. So again, we're broken record here, but if leave is more likely than not to be settled through non-cash means other than the conversion to the defined benefit post-employment benefits, the liability is based on the amount to be settled. So if there's some other non-cash settlement other than conversion to defined benefit, because if you remember on the earlier slide, if it's converting to a defined benefit post-employment benefit plan, it's not part of the liability. But if it's another means and it's a non-cash, it's going to be based on the amount settled, and that's going to be pulled into the liability. If there's a payment that goes through a distribution to an individual account, such as healthcare premiums, it's included if it meets the recognition criteria. So it's an if then, right? So it's a maybe or maybe not. And then any changes in the measurement of the liability in future periods due to the change in the hourly rates or anything like that, that gets rolled through prospectively. So each year you have the calculation at the end of using the end of the year hourly rates. Just, this is nothing different than what's been done in the past as far as that. You're not using anything like that. So you're rolling that change through the current year. And so this is where we probably should pause for a second and talk about the idea. We've gotten the question. I know, Dave, we were going to do it at the poll. Well, here we are. We're at the poll. We'll do it at the poll. Okay, so our next poll: how does your agency currently handle leave that is convertible to post-employment benefits? So do you record it in compensated absences, you treat it as pension and OPEB, or we don't accrue for it, or we're not sure? So what I was going to start talking about is we get the question of whether we're going to develop a template. Are we going to develop a template for compensated absences that we can share for our clients? Because as most of you know out there, if there's a statement that's more of a generic type statement where it's not specific to each individual entity, we happily create templates so that we can share that, and note disclosure examples and things like that. And we would share it, but we're not for, kind of like with leases and SPIDAs, we did have some example amortization schedules, but not the actual determinations, right? Or I take that back. We did have a tool for the determination, but not, the how we do everything every year. This statement is just too specific from every entity. Your own MOUs, or if you don't have an MOU and everything's based on a personnel manual or some other agreement with your employees, it's just too client specific. And then on top of that, the more likely than not part, that is definitely specific to your entity, right,
Yeah.
David? Like it's it could be these employees never cash out, these employees always cash out, these employees keep it to the end and never use sick leave and stay till the end. So it's really going to be client specific. So that's why we're not doing a template. We're happy to review what you develop, give comments on it, And like I said, make sure you're on the right track. And then of course, we're going to audit it in the end. Yes.
And there is one on the GASB or GFOA's website. We'll talk about that.
Yes,
Yeah.
yes, that's true. We're not developing one. There are some tools out there that we've got a link to at the end of the session. All right, so let's see. Yeah, not sure. Yes. Yeah, and it's probably is kind of all across the board. That is, you treat it as pension OPEB, that makes sense. Don't accrue for it and record it as compensated absences. So interesting. All right.
And there are quite a few questions.
Uh-oh. Okay, hit us.
Okay, so regarding pay rates, so this is like for recording or calculating the liability. Regarding pay rates, if our labor agreements are effective June 29, 2025, do we use those rates for the calculations?
Yes.
If you're a
Yes.
June 30 year end, yes, right?
Yes.
So,
Yes.
Yep.
okay, question number 2 for poll number 3, the one that was just up. Is this referring to hours reportable to the pension plan as pensionable service credit?
Ooh, good question. Yeah, so it's one of those things like if you're reporting it to the pension plan and it's getting rolled into your actuarial valuation, that's kind of a trigger for thinking that it's not going to be part of the compensated absences. Because again, you don't want that double up. So if it is something that you're reporting and it's getting rolled into the liability, then yes. If it's not, that's gonna be my answer. And then if it's not, no. Yeah. Good question.
Okay, if we are not paying for Social Security, are we supposed to calculate the CalPERS employer contribution to each employee on the list?
It's a good question. No. So because the CalPERS part would be the double up. So since it's the pension contribution instead of Social Security, so you just would not have that component. So you would just have the Medicare component. So is that the 1.5? Don't judge me if I'm off. And again, just the employer share of the Medicare. So you would not have the Social Security component in your calculation.
We should use the pay rates as of the last day of the fiscal year. For
Correct.
example, June 30, 2025 to calculate the liability. I think,
Yep.
yes, you guys have confirmed that.
Yes.
If COLA rates will go up in mid-July, do we need to use June 2025 or July 2025 rates since the latter is known?
Good question.
Yep.
You will use the June 30. Yes.
Yep.
And so that's, yeah, you don't use this. So even though you know it's happening and you know it's happening for the next 3 years, but you're going to use the rate at June 30. So in that other question where if the new rate is effective June 29th, then you're going to use that new rate because it's effective on June 30. But if it's effective after, you're going to use the rate at June 30.
Okay, and then one last one. Oh wait, no, there's more. Okay, if use it or lose it leave is granted for calendar year, and as of June 30th, a person has 50-hour balance, is the 50-hour included in the liability?
Yes, I think
Yes.
we
If
answered that
you think
one.
it's more likely or not, they're going to use it.
Yeah.
And that's, again, you have to look at your own organization's historical trends.
Okay.
Yep.
And one last one. Okay. Can you clarify if health insurance cost is included as salary related payments? For example, if an employee takes leave for 2 weeks, the agency is still paying for the full month for health insurance.
No. My gut is going to say no, because that's going to be rolled into other
That's a
Yeah.
different accrued liability.
different accrued liability. Part of it's going to be rolled into OPEB because it falls into the, into the OPEB world. So no, you would not have to.
It's nothing that would be paid out at conversion. Yeah. Determination. Yep.
Okay. All right. That's it for now.
Awesome. Keep bringing them on. This is good. We like the questions. All right.
All right. Example.
Now we're going to get some examples, but of course, before I flip over, even though you all have the slides, these are just examples, just to start giving you the visual of what things may or may not look like. And so, of course, you have to look at your own facts and circumstances, and there, even as we've gone through this, we've tweaked them and realized, we may have one thing incorrect here and there, and and so you have to kind of look through it, and we're going to talk about the differences. So don't take these as this is the way it's going to be. These are just examples. So in this first example, and so you'll see we use the word vested and unvested because that's the terminology we've all worried about over the, since GASB 16, if it's vested or unvested, and that rolls into calculating the liability. So, so that's why we left the words in here, just to show you how it does not impact, it's not factored into the calculation under 101. So under the first question, or excuse me, example, so we've got, and we're just focusing on sick leave because vacation is pretty straightforward, and GASB 101 doesn't have dramatic impacts on vacation, because vacation generally is, you get it, right? Most, it's paid out at the end and it's not. But if you have other components, then you have to apply some of these rules and, the GASB 101 rules to vacation. But generally, sick leave is the one that's impacted by a lot of these changes under the statement. So in this example, it's paid at 50% if after the employees have 5 years of service. And when we say paid, at 50% at termination or retirement, and employee balance values so those with over 5 years, there's $1.2 million, and under 5-year people, so the people that aren't vested, it's $1.4 million. And we're saying at the end of the fiscal year. So under the existing guidance, you would have a liability for $600,000, right? You've got $1.2 million. It would be paid out at 50%, $600,000. Now, let's be honest, most clients, that's where it stopped. But in our example, technically, the unvested component probably should have had a liability as well. Just, kind of based on history, 25% will stay longer than 5 years. And so there will be some vesting that will hit those. So of the 1.4 million, 25%, then multiply it by the 50%. So 175,000. So your liability as of the end of the fiscal year, 775,000. But like I said, let's be honest, most of you would have only had booked 600,000 and we were all okay with it. So under 101, just breaking down those same components, of course, like we said, you can throw out vesting and analyze it as a whole, but we just wanted to show the difference between the two groups. So for the vested employee, so based on history, more likely than not, this is an example, 80% of them are going to not use it all up and get paid at termination at that 50%. So we take the 1.2, multiply it by the 80%, and then multiply it by the 50%. And so that gets you $480,000 for that component. And then 20% of them are going to use it before termination. So then you take 1.2 million times 20% times 100%, because they're going to use it. So it's not going to the point of being paid out at the 50%. So that's 240,000. So notice we're already at $720,000, which is more than what you would have had on the books under the, ignoring the 175, more than what you would have had on the books, 600,000. And then the unvested component, you then have to analyze that based on history. More likely than not, 25% are going to reach 5 years and get paid. Okay, so we got that 50% component of that. And then 40% of them are going to use it before termination. So now you have a $560,000 liability for that component. And then roughly 35% of them are going to leave. They're not going to get to the point of the vesting. And so it'll be forfeited. So again, you can break it down into the vested and unvested, or you can analyze it as a whole, looking at the general idea of how many get paid at termination versus use it before termination, and then how much will be forfeited. So you can analyze it as a whole. And so you can see under 101, the liability doubles or more than doubles to 1.45. This is just an example. It's not going to be the same for all of you. And again, we're doing general percentages on that, more likely than not, the 80%, the 20%, the 25, the 40. So you can analyze it in groups, in segments of the population. You can analyze it by your MOUs. Maybe this component of employees tend to, as a whole, use it or don't use it, or you can do it as a whole. There's no rule. It just needs to be, as when you think about it from the auditor perspective, it has to be reasonable and auditable, right? Supportable. You've got a basis for how you're coming up with these components. Most clients that I've seen so far that have started to develop some spreadsheets are doing it by employees as a whole, which is fine, but the percentages that are being applied might be by groups and batches, not by each individual, not looking at each employee's individual history.
And Amy, it came up in the chat just about, materiality is our friend type thing. And you can see it here. It's, again, you got to remember, this is going to be at the end of the Y. So
Yeah,
you have to assess it within your own organization regardless, but then it's up to management, to see is this material change.
agreed. Yep. Agreed. Okay, and then, yeah, and because it was also think we're just doing, when we're looking at this also, we're just looking at the sick leave component. And so, layered on top of this, you're going to have the vacation and
Yep.
maybe any others that might be in there as well. So our next example is carryover without limits, but nothing is paid at separation. So the employee balance values $2.6 million. So there's $2.6 million of potential if you were to multiply everything out. So under the existing guidance, 0 was booked, right? There's no liability because they can carry it over, but there's nothing paid at separation. So under the GASB 16 rules, there was no liability for that component. But over under 101, now you have to look at that more likelier than not, how many of them are going to use it prior to separation. So we know in the end, they're going to get 0. But what's the more likely than not? The phrase I love, the 50% plus a feather, more likely than not to use it before termination. That's the liability. And this, thinking about this, it kind of goes along the theme. As painful as the last few GASB statements have been, you think about the ultimate theme of the last round of GASBs is about unrecorded liabilities. At the end of the fiscal year, what are the liabilities related to those assets that you have? Even though you might pay it out in the future with different resources, at that moment, what are the liabilities that aren't on the books? Over the last, I don't know how many years, 10, 12 years, we've booked the pension, booked the OPEB, now leases are in there, now SPITAs are in there, those unrecorded liabilities that really are long-term commitments. Now you're bringing in long-term leave that is going to be paid. It's not that it's going to be a 0 and no cash is ever going to go out the door. You are paying the employees overtime based on those balances. So now it's about more likely than not used before termination in this. We just, 60% are going to use it before termination. So now you have a liability to book of $1.5 million, and then 40% will be forfeited. So the 40% still is 0. So that didn't change. You're not paying anything out at the end. If they have a balance when they terminate, doesn't matter, they get 0. So that'd be a $1.5 million liability. All right, David's going to talk about his happy little water district.
Yes. So normally when we first started looking at this GASB, we were thinking that it would be increasing the comp abs, like Amy had in the example before, but we actually came across an example of an organization where it actually reduced the liability. And kind of the details I'll just get into just really high level is this at this organization. And again, management assessed it and looked at what the impact would be, but it is based on historical trends. People that come to this organization stay until retirement, and then all that comp time gets converted to the post-employment benefit plan. And so, in that sense, we were showing a comp abs amount, but theoretically that would be paid out at 50% at termination. But because more likely not people are going to stay to retirement and convert that into benefit, it wouldn't be booked as a comp abs because we'd be doubling it up, right? And so theoretically, it would have reduced their comp abs by 70,000. They deemed that as immaterial, and we agreed, but they still did the assessment. But it was interesting to see it reduce the comp abs rather than increases, which would normally be in effect.
Yeah, good example. All right. And then our next example, because some of you might have, instead of being paid out at 50%, there might be an ability to cash out a flat amount at retirement. So in this example, most likely, and I have the caveat at the bottom, the treatment under the current guidance, under GASB 16 could have varied as far as how that $2.6 million balance at the end of the year was being treated, whether there was any sort of calculation to estimate $8,000, but for most of them it was probably a 0 because you just weren't factoring that in. But maybe not, maybe you had some component of it. But under 101, so I've got a typo there, conciting of 50 employees Is conciting a word? Because I spell checked this thing. Weird. Oh, the snip doesn't spell check.
Ah,
Aha. Okay. So in this example, 2.6 million consisted of 50 employees. So analyzing those employees in the breakdown based on the history, more likely than not, 80% of them are going to use it before termination. So you take the 2.6, multiply the 80%, and then we have 100% because they're going to use it. So 2,080,000. So now we went from 0, now we've got a $2 million liability to book. Then of the remaining 20%, 10% are expected to keep a balance, have a balance, and convert a flat amount of $8,000 at retirement. And so 40%, excuse me, $40,000. And then of the remaining 20% after the above, the rest would be forfeited. So then you would have this $480,000 forfeit. So your liability would be just the 2080 plus the 40. So $2.12 million. You went from 0 to now you have a $2 million liability. So that's something to think about as well. So you might have some other kind of components. It might not be as simple as the other examples. So it's all about analyzing that more likely than not. All right. So any questions before we go to the next slide? Just to
There are three
okay with taking-
questions.
Sure.
I'm gonna go to the third one first, just because it's based on your tables that you guys were just discussing. So why do we include the 20% used before termination for the vested sick leave, but do not include the 40% used before termination for unvested in the liability?
because you're looking at two different groups. You're looking
Well,
at people that
yeah.
are less than 5 years and people that are more than 5 years. And based on historical trends, people that stay less than 5 years, burn through it, use it before termination, but people more than 5 years, only 40%. So it's based
Yeah.
on,
So we are including it though. I think they think it's not in the math. Does the math work? We have 480. So this one is 480 plus 240 plus 175 plus the 560 equals the 1.4. I hope. I think it does.
Okay.
Yeah.
Yeah.
oh, I see.
Yeah, I think,
see what you're
yeah.
saying.
Okay, so it is included.
It is included. Yes.
Okay. All right. Let's see, let me go to the top here. How are we going to treat a sick bank that is unlimited and can be converted to service credit when they retire? Then if the employee worked 25 years and more, they have an option to cash out 10% of their balance upon retirement. Are we supposed to include the 10% in the compensated balance?
I think so. I think that's an interesting one because you're right, because you've got this other type of conversion. You're getting a credit, which I think does not qualify under the. But then I think I'm going to flip back for a second. I think it would fall under. Not this one. That's exceptions. Was it the? God, I thought you had I think you had a slide on it, David.
For
But I'm thinking of-
unlimited leave,
I know. Is that?
Or
unlimited leave is not included.
Yeah. But they have that cash out provision. So I think that's where, because there's a cash out provision in the end, the cash out
Okay.
provision would be considered.
Yep.
So the 10%, the option to cash out 10%.
Yeah.
And then-
So how many, what is the likely, like, and that's where you're looking, the more likely than not. How many have exhausted it before they get to the point of retirement?
So what's the likelihood that the employees are going to work 25 years or more?
Agreed. Yeah, you would have, yes, exactly. You would have a couple components. More likely than not of the 25% or 25 years or more. You might already have people in that bucket. So then you're going to have the analysis of the people that are in the bucket have already met that threshold of 25 years. Now, what's the likelihood that they're going to make it to the point of cash out? Excuse me, what's the likelihood that they take a cash out? And then for the people that are below the 25 years, what's the likelihood of them making it to the 25 and getting to the cash out? And then the likelihood of the people that are not gonna be there for 25 years and it's just gonna be conversion, if anything. No, there'd be 0 then for those people. Yeah.
Okay.
Hope that was clear.
We only pay sick leave at retirement. It can also be converted to service credit. How would we approach calculating that for 101?
You have to look at it by group. I mean, how likely is it somebody's going to use that, converting it to service credit? then that would be
Exactly.
excluded from the liability. So
Yeah.
that's based on historical trends, and I would go back, 3 to 5 years and see, based on those retirees, what did they do, and then look at that going forward.
Exactly. And I think this is the hardest component of
Right.
101 that people are struggling with is you're going to have a liability for the people that are going to use the leave from here into the future. That's where you're estimating. The more likely and not going to use it as leave. Then after that, you worry about you're going to make it to the point of, a forfeit or a payout or a something else.
It converting.
It converting, yeah. So I think that is the component. And I've had some people struggle with thinking about that it's the use it in the next year. No, it's not
No.
limited to the next year. After you're done with all these calculations, then you do an estimate of what's going to be paid in the next year and what's the long-term liability. So then, that's after you figure out the global liability, then you figure out the current and non-current portion. But or not to use it doesn't mean just over the next 12 months. It means of that balance, how much is going to be paid as cash, how much is going to be used as sick leave over time. I think that's one of the hardest components to realize that that's what it's trying to say.
Okay, and one last question. If PERS pension cost for defined benefit plan is part of pension liability, it does not get included in salary related payments for leave?
Agreed. Correct. Correct.
Oh, sorry, one more, which you kind of already alluded to, but so
Yeah.
comp abs under 101 needs to be separated short-term versus long-term.
Yes, after you're all
Yeah.
done, it is like any of the other long-term liabilities. You'll have the due in 1 year and then due in more than 1 year. So you will have to guesstimate that number. And that's kind of the easy, after you're through everything, that's the easiest part. Like roughly what do you pay out in a year in sick leave? And most of you, and that estimate can be using the old, had some entities that would say 2080, it doesn't, you don't have to overanalyze that number either. You just think it's going to be in the financials as the due in 1 year and the due in more than 1 year.
Okay.
All right. Are we caught up?
There's still a couple. You might want to move forward a little bit.
Yeah,
There's a
let's-
few
Okay.
more kind of coming up. So
Okay,
yeah.
that's fine.
We'll do some at the
Yeah,
end.
we
Okay.
can circle back and we can leave the time at the end too to answer all of them too. How are we doing
Yeah.
on time? About 8 minutes. Okay.
Mhm.
I think we're about quick because this is going to be sorry. Okay, so sick leave types and treatments. This is straight, well, I boiled it down, but this is right out of the GASB in the back. There's some examples of different example of leaves and how they're treated. And so I really like this because it helps you understand a little bit more, and some of these questions that have been asking as well. If you have leave that's earned each month, carries over without limit, and at the end of the fiscal year, it's not paid at termination, that's where you then book the liabilities for the portion more likely than not to be used. And then the rest is not, right? Then you have zero for the rest, but how much is going to be used, and that's your liability. So if you have leave that is earned each month, does not carry over at the end of the fiscal year. So this is answering your fiscal versus calendar question, these next two questions. So if it doesn't carry over at the end of the fiscal year and it's not paid at termination, you're not recognizing anything as a liability. If it's earned each month, does not carry over at the end of a calendar year, but you have I should have said, but you have a June 30 year end and it's not paid at termination, the liability for the portion more likely than not to be used before 12/31 forfeiture. So that's that 50 hours question that someone asked. I forgot to put in that part. If you have a 6/30 year end or something other than the calendar year end is why you would have that liability for the part more likely than not to be used at the end of the fiscal year, the June 30 year. And then if you have leave that's earned each month, carries over, it's paid at a certain percentage of termination, then you have a liability for the portion more likely than not to be used as paid leave, and then a liability for the more likely than not that's not going to be used. Then a liability for the portion more likely than not that's going to be paid at termination. So you have those two components, which is that one example that we had. All right. Then note disclosures. This is the easiest. Guess what? The words, no change. The only change you're going to have to your footnote, the words of your footnote is going to be if during this process you realize, oops, we didn't really disclose something correctly, or something changed in an MOU. We don't quite have the policy in the footnotes correctly. if there are no, if your words were right back then, there's no change to the words this year. Now, table-wise, dollar-wise, that's where the change comes in. You now have the option to present the net increase or decrease in the table of changes as a net number. As David mentioned, they knew we were plugging, and it was not anything that anybody really cared about, knowing the increase and decrease. And so you can report it as a net amount. And then the other part to the words, I forgot, there is one change to the words. You're no longer required to disclose the governmental fund or funds used to liquidate the compensated absences. That disclosure can come out of the footnote, because who in this group didn't say that the general fund was used, or the fund with the liability, referring to the enterprise funds, or the general fund was used to record the liability? It's no longer required to include that. So in the note disclosure, so if in this example, if your compensated absences are included in your long-term liabilities footnote, as David had mentioned earlier, you can see on the compensated absences, I oversnipped here. You're missing the actual change. Sorry. When I made the slide cute, it cut off the retirements column. I didn't see, but you see the other liabilities up on the top of the additions. You can see the asterisk next to the 143,000, and then the note at the bottom, change in the compensated absences liability is presented as a net change. And so you need to put that by any of, if it's an increase or a decrease, just put that asterisk. You're no longer required to gross them up. So in the business type activities, the change was a decrease in this example, but it's hiding behind the blue screen here. All right, then another little silly. We are all accountants here. And then, so your audit requests and impacts. So this is just to give you the heads up, what we're going to need as part of the audit, but we're going to do the poll first, our last poll for this session. Make sure we're still okay. We have 4 minutes. Okay. So have you started preparing? Yes, no, maybe so, or we're here, aren't we?
I like that last one.
Yes.
Okay, so do you want the questions while they're responding
Sure.
to that?
Sure.
Okay.
Yeah.
Well, one was just confirming, and I think we already responded, but in the chat, there was one about, well, currently we only disclose comp abs under basically the SSAP because it has been immaterial to our financial statements. If the result of the enhanced calculation based under GASB 101 is still immaterial, then we can still continue with the notes and no need for additional separate notes, correct?
Correct. Agreed.
Yep.
And if that is the case and you prepare an ACFR and you go to fill out your GFOA checklist and it says, did you implement this statement? Your answer is yes. Because just because if it's not material, you still considered it, you addressed it, you just didn't have to make any change, you still implemented it, because that can cause confusion for some people.
Yeah.
All right, Whitney.
Yeah, so I think that's the confusion is if it's immaterial, you are still implementing. It just means that you don't have a change.
Yep.
in your
Agreed.
job.
Yep. Agreed. All right. Ooh, this is very, wow, very down the middle here. Interesting. Okay.
Yeah.
So get started. Those of you that have not, so well underway, good. Started but not finished, that's fine. So not yet, but planning to, and we are here, aren't we? Yes, jump on it. Because we found that clients, like I said, the ones that have started to dig into it, trying to figure out what historical information they have, to figure out those trends, to figure out the more likely than not question, is where the time sucker, that's what can be. Your HR department can help you with a lot of those things, and it depends on your systems, of course. If your systems are old, you might not have some of the resources, so you might have to figure out another way. And that's where we've got the link at the end of the session for the GFOA example, because they do, you don't have to do the everybody. You can do test groups and extrapolate it to the population. So you might be able to find information for people that kind of represent that particular group or MOU or component of your numbers, and then you're going to just extrapolate out. So that's where you don't have to do every individual. You can do it based on trends as a whole or for a source group. And then remember, that was one of the earlier slides that David talked about, which is the if a trend doesn't represent the population, you want to document that and document why you're not, even though this is the trend, it could be that your entity had a high number of retirements in a particular year that does not represent the normal
Yep.
normal trend or something that happened at your entity. All right, so I'm gonna scoot quickly through. Sorry, are there more questions, Vix? I'm realizing we're at the very end.
There are. How much more do you have?
We only have 2 slides, I think, more. So
Okay.
this is just take a look at this on your handouts. It's just the information. Obviously, we're going to want the summary by the MOUs of your policies, or your MOU or your personnel policies. And then that's at interim. We want to know, what are you doing? Then at final, we want the calculations, right? And we want to look at the calculations. We want to look at the basis, and we're going to be testing it. So there will be things on the interim and closing checklists. And then we're going to test the balances to make sure you're including things that should be or excluding things that shouldn't be in there, and making sure it's reasonable, and then determining what additional testing we may have to do. And then the resources we keep referring to. So the GASB online codification is that GARS system. If you were in the last class, I couldn't remember the login, gars.gasb.org. So it's free, even though it's called a login. It is a free system where you can get into the codification and find all those resources. It's very robust and very user-friendly when it comes to searching these days. And then Define 101 compensated absences tool from GFOA. You have to be a member, so you do have to log into that one to download the material, but it is something to get an idea, kind of to see a tool that they've developed as an example. All right, and so then we'll go into any other questions.
Yeah, so just before that, so Whitney has posted the survey in case anyone doesn't want to stay through the last final questions. The survey is up, and then for anyone that wants to continue on to listen to the questions, let's go through
Okay.
these. One was, how are agencies analyzing historical use of sick leave, hours used versus hours accrued over the last 5 years? Question mark. What are agencies doing? And it's probably a good question for like CSMFO, like
It is
That
good.
would be a good one for the Litzer, right? For
Yeah,
season
it
of
would, to see what others are doing. I know, as I said for clients, what I've been saying is, see what you have. Because obviously in year 1, you may not have as much historical data, but then you can keep, what's the word I want? Clarifying your calculation as you move forward. Like maybe you can only find 3 years of information, but then in year 2, now you have 4 years of information. Start layering it up, figure out what you do and don't have, talk to your, your HR department. Do they have any sort of records or things like that? And figure out, it's kind of like anything else, kind of circle the drain, right? See what you have and what you can find out, and then what are you missing? So now, if you're missing a component that you think is going to be important to figuring out the calculation, how could you get it? Is it something that's going to be obtainable, or is it that we're just going to have to go with a conversation, a conversation with someone from there? But see if you can run any payroll reports for payouts when it comes to that cash out, or any retirement history for what balances people have at the end. And I know that's going to vary from entity to entity as far as how robust your ERP system may or may not be, and what reports you can run. But if you can at least get, a trend is not 1 year, right? It's going to be more than 2, hopefully 3 gives you a trend. You can start, it does not have to be 5, 10, 15. It could be, if you can get 5 years, great, because that's where you can start developing trends. What are the actuary? If any of you had Mushtaba as your actuary, he'd always talk about a blip versus a trend when it comes to actuarial numbers. So it's, 1 year is a blip. The trend is something much more than that. So hopefully that, I know it didn't quite answer the question, but hopefully it at least gets you thinking
I
on
think
ways.
like I said, I mean, we can't really speak for the other agencies, so I think that's a good question to ask your peer group.
Yeah.
Does the calculation of the liability require a flow assumption, FIFO or LIFO? I don't think so.
It doesn't require it. You
Mhm.
can decide if you want to roll it in. I haven't seen anything about FIFO LIFO. That's a good question, but I didn't see anything even in the Q&A
No.
or the help about it. No. So it's not, you can, that's where, I think that's where, you know, it is a guesstimate. It isn't, not guesstimate, it is an estimate that's going to be in your financial statements. So it's your best guess based on the data that your inputs that you can provide. And then you're not required to, you're not required to do this FIFO, LIFO. It's, you know, you can apply that percentage or whatever method you're using to a whole group, you know, to everybody, or again, breaking it down by MOU or employee groups from that point.
Okay. How do you define unlimited leave?
How do we define unlimited leave? Is
Well,
just that.
I mean,
There's no cap.
There's no
Unlimited
cap.
unlimited leave is there's no cap is what it
Mhm.
means in the
Mhm.
definition in this GASB. It's there's no, like, some entities can cap it off at, you can up to 360 hours or so many hours per year, and then they're paid out, or so that's what it means with unlimited. Is there are no caps.
Yeah, no cap on the accrual. Okay, just to clarify, the calculation is done using data as of June 30, 2024 to see if liability requires restating beginning balance, and it needs to be calculated again as of June 30, 2025 to adjust the liability.
Agreed. I had that in my notes and I never said it, I don't think. Yes, correct. You do need to book, or excuse me, calculate at the beginning of the year and calculate it at the end of the year. So your rates in effect at the beginning of the fiscal year and your rates in effect at the end of the fiscal year, applying this same, you know, whatever your methodology at the beginning of the year and the methodology at the end of the year to determine whether the effect on the beginning balance is material and need to be restated. Yep, good question.
Okay. And then there's a question in the chat. How many years back should we go for the calculation?
I'm assuming that means for the trend, so it's kind of goes along those
Yeah,
trend
which I
lines,
think you
but
already
yeah.
answered.
like
It's
3
gonna
to
be
5
3 to
years,
5.
and then just, you know, flesh out all the blips.
Yeah. Okay, and I think that concludes all of the questions, and yeah, we're definitely over. So thank you all. Thank you all for attending. Thank you all for your questions. I think this was great. Thank you, Amy and David, for the wonderful presentation, and thanks everyone who attended May's Live. Again, the survey link, Whitney just reposted it again. And so just definitely appreciate Amy and David for putting all of this together, and Whitney also for coordinating all of us. She herded all the cats.
Yes.
So thanks everyone, and go have some lunch now. All right.
Thank
And-
you.
All right.
And do good in implementing your GASB 101. So, all right. Thanks all.
Thank you,
Thank
everybody.
you.
Did it not record?
It does, but you can't, it doesn't stop until you end the webinar.
Oh, gotcha. Okay. Just
Yeah, if you press stop now, it doesn't want to, it wants to convert it in a
Okay.
different way, I guess.
All right,
It's kind of
great.
strange.
I will leave. All right. Oh, hi, Carol. All right.
Okay,
All right.
I'll end the webinar.
All right.